Richard Werner just went on the Tucker Carlson podcast and just exposed the banks.
Banks are not financial intermediaries. Banks are special. They have a unique power that no other player in the economy has, and that is the power to create money.
And following up to a paper that he wrote, Can Individual Banks Create Money Out of Nothing?, exploded onto the scene, and now it's getting publicized everywhere. Almost 11 years later, it's finally getting the recognition it deserves. You see, in banking, one of the most common theories and what they want all of us, the public, to really believe and understand is something called the Financial Intermediation Theory. What this says is very simple, right? And this is what I thought my entire life. People walk into banks, they give the bank $1,000, the bank takes the $1,000, and then they go lend it out to somebody. And then the person gets paid a small interest return, right? Because the reality is a deposit is looked at as you lending money to the bank, so the bank has to give you something in return. Then they go and they lend the money out to somebody else for a greater return. And my entire life, I thought this was how the banking system was founded. And I was wrong. And I'm gonna go into a bigger example on how banking was actually started in England here in a few minutes. The second idea that like most people after that, if they kind of study it a little further, they argue that money is created through the banks, but it's created through something called the Fractional Reserve Theory. So I come into the bank, I give them $1,000, and then they have $1,000, now they go lend out 10, right? So they still have a percentage of what they lend out. But what Richard Werner exposed was that, as a matter of fact, there's literally the banks don't have to have any reserve in order to be able to do this. So how do they accomplish this? Right? Because they actually count it as a liability against the borrower, but they also count it as a deposit. And so what happens is the bank is issuing a $1,000 consumer loan, and they're not moving $1,000 from their reserve requirement into some account, into some safe, saying, hey, we got to keep this as collateral because we just lent somebody $1,000. No, there's no money movement. Their balances don't drop anywhere. He actually went in and looked at the balances at one of the big banks and tried to see if him borrowing $1 million, or whatever the amount was going to decrease their overall balances by anything, and it didn't. So then what happens is called the credit creation theory, where literally the banks are able to issue credit to consumers without collateralizing anything against it. So it's just a fugazi, right? They're just creating these digits and issuing it to somebody so then they can go spend. What does this remind you of?
Credit card.
The credit cards don't have anything intrinsically. They're not holding anything. They're just giving credit to this individual. And so what happens when credit is issued to an individual person? Well, they have more money to spend. And yeah, that's good for the economy, right? Because money starts to move and more money gets spent. But guess what happens as there's more access to capital? Everything goes up in price. And that's the most inflationary thing there is. It's not the interest rates. It's not Jerome Powell holding the federal fund rate at 4.25%. It's all of this money that's getting put out into the economy, and it's fake money. There's no more hard cash. There's no gold standard. Nixon got rid of that.
I'm not a crook.
It's just a fugazi. This money's getting printed out of thin air, and you're able to buy goods and services, and then who's getting the money back? The banks, the credit card companies. This is money that never existed that you're spending, but you're giving them back your actual money. This is why we had so much inflation during the pandemic. You see, the pandemic wasn't a physical illness, it was a financial crisis. What happened when they lowered the cost of money is they gave everybody so much more access to money. So what happens when people have more money to spend? There's more supply of money. And so therefore, everything starts to go up in cost because there's more people wanting that same item.
Okay, toilet paper, toilet paper, toilet paper.
Now it goes even deeper because I was like, well, how does this work for mortgages? Like, if there's more money for mortgages, then that would mean the cost of houses would intrinsically go up. And so here we are trying to argue with sellers and buyers and realtors and lenders, and yet it's the banks. The banks are the ones that are issuing loans without collateralizing it at all. There's not lending out $1 million of your deposits. They're just issuing a $1,000 promissory note. And then when they're getting back, that's the part of the money creation. I'm so dumbfounded by this whole idea. And so I actually called one of the top lenders in the United States who has over $1 billion a year that they issue in mortgages and non-qualified mortgages. So it's not bought by Fannie or Freddie. And I know that they don't have the ability to create money. And so what happens is they get this pool of money, they get these $1 billion that they have to issue, right? And so they're the intermediate between the buyer and the actual bank that's issuing the money, because they're borrowing the money. And so this other individual, this third individual that the buyer never sees, that money is either coming from the Fed, where they're borrowing $1 billion at a 4.25%, and then they're issuing it to the lender at a 6.25%, and then selling it to the buyer at 9%, at 8%. And so there starts to be all of these spreads, but the money comes back. You see, when that money gets issued, when those $1 million get loaned out, those aren't put in a safe. Those $1 million aren't moved somewhere. Those $1 million are sold and bought and sold and bought. And so the buyer gets a home for $1 million, and the $1 million are issued to the seller. But that note, that promissory note, that piece of paper, the lender takes that piece of paper, that promissory note, and then they go sell it so they can replenish that $1 billion warehouse line that they have. And so they sell it to this third institution. Now, when they sell the loan, they can make anywhere between 36 points. So they can make $30,000 to $60,000 on the sale of the loan. There you go, that's more money creation. Because now they're getting money from the secondary market. They make money on the front end from the buyer, then they're making money from the secondary. Then that loan gets sold and packaged into a mortgage-backed security. And then that loan gets sold again, and it gets sold again, and it gets bought and sold again. And so that $1 million issuance on the original note might be bought and sold 6 times. And so all these different institutions are making money. And the end bank that issued the original $1 million, it could be all the way down to the central bank. When you go all the way down the line, when you actually go and look at it and you follow the money, when it all started, there wasn't $1 million that got put into an account to issue that out. That money came out of nowhere. And so it's the banks that are making everything unaffordable because they have a unique ability to create money out of nothing. So if you find this interesting, aside from liking and subscribing to our channel, which we're trying to grow to 1,000 followers right now, please make sure you click on the link in the description where we have the full article along with the video we reference. We appreciate you watching, following, subscribing, and leave your thoughts in the comments. We appreciate y'all.